All right, ladies and gentlemen, welcome to the Market Outlook call here today. And we appreciate you taking the time to join us on this volatile day. We've had a couple of rough days in the market. If you've been following along, Friday last week was pretty tough. And then today down about 3% on the S&P. So we are here to talk about what's going on in the markets. I'm Nick Stenger. We're Stenger Family Office. For the past 43 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Before we jump in, I want to thank you all for being on today's call. I also want to turn your attention to Investor Day, which is quickly approaching November 7th and 8th, downtown Naperville. If you are looking for additional clarity and confidence, insights, the data, math, statistics, research into why we do what we do at Stenger Family Office and how we select the investments in your portfolio, don't miss Investor Day. We've got a stack lineup. It kicks off on Thursday night, November 7th at the Naperville Settlement Innovation Gateway. You can't miss it. And then Friday, come back and join us for a half day of guest speakers, including featuring the legendary Dr. Ed Yardeni. Get this thing on the calendar. You can't miss it. It is the biggest event we do all year long. And we are 75% sold out already. So if you are thinking about coming, make sure you get it on the calendar. We can't wait to see you November 7th and 8th for Investor Day. Well, if you listen to the weekly show and read the articles, you know that we talk a lot about clarity and confidence, and that's what we want to do. We want to give you an idea of what to expect so you know if you should keep staying on your plan. And usually the answer is yes. And so I'm going to just jump ahead here. I don't want to spoil the call for you, but I'm going to tell you what I've always told you is to stay on your plan. Do not panic. And so you need that clarity and confidence. When we go through these ups and downs, it starts to make a lot more sense on days like today, where the market's down 3%. And so I keep telling you, subscribe to the show, get it out to your friends and family, get it out to them, share it with them, like the episodes, go on YouTube, subscribe to it. That's the only way. That's the antidote to the media doom and gloom. And constantly, we're going to talk about this in a second, but constantly when we have these declines in the market, these corrections, these panics, these sell-offs, the media is going to try and just scare the pants off of us. And so that's why you need this. The weekly show is there once a week for an hour to try and give you a little bit of good news, the antidote to the bad news. So that's what we're trying to do with all this content. So the market opened up in the pre-market down about 5%. I was up this morning looking at the pre-market trading, and I was a little surprised it was down 5%. We didn't end down 5% for the day, which is a good sign. We ended down about 3%, 3.1%. And so now the S&P is hovering right around 5,100 points. It's about a 9% correction from the peak all-time high. We are quickly approaching, getting very close to a 10% correction. And I think that's probably where we're going to end up. And so what I want to tell you today is a little history on corrections, why these are not that scary, why you shouldn't be worried about this one in particular, how many of these corrections we've been through in the past. And then I want to just give you a little perspective on where I think we're going. I'm going to give you some takeaways on what to do during these times. And then I want to wrap up with just a couple of points on, are we in a correction or are we going to turn into a recession? And then we will talk about what I would call an all-weather portfolio, a portfolio that's designed, not guaranteed, but designed to get you through all types of weather, including these market corrections. So let's start with the common nature of corrections. Since 1950, there have been 38 market corrections. Wow. 10% corrections happen on average, one every 1.8 years. Sometimes even more than that, sometimes every 1.1 years, depending on the decade you're looking at. So almost every year, or at least every other year, you're going to have a 10% decline. This is not a reason to run for the hills. And if you think a 10% correction is a reason to run for the hills, you would be doing that every year almost. So not uncommon to have a 10% pullback in the markets. An average intra-year decline, meaning despite how the year turns out, the average drawdown within the calendar year, within the 12-month period, is 14%. We're not at 14 yet. We're at 10. Could we get down to 14? Maybe. I think it's somewhat unlikely. It's possible, but I think it's somewhat unlikely. And we do have 20-25% declines about every 5 years. I don't think we're going into a 20-25% decline. I will tell you why, but I think we are going to be in this 10% pullback for a bit. We're in an election year. We're in a volatile season in the stock market. This is just part of the course. It also so happens that August through October are seasonally the weakest months in the stock market. And what that means is a lot of people take profits. You have a lot of big pension funds. You have a lot of big hedge funds. You have mutual fund managers that are looking at their returns for 2024, and they're looking at big tech in particular. They're looking at a lot of these companies where they were already up 20-25%, for example, on Microsoft, or 30% on Amazon, or 30% on Walmart, and they're saying it's time to take some profit. So you're getting some rebalancing that's going on too. It happens every year. In fact, we had this last July through October. You may have forgotten this already. We wrote that article, Buy Baby, trying to tell you, buy stocks, they're cheap. And sure enough, that was the right advice. This happens to be a seasonally weak time in the market. The last reason why this tends to be a volatile time is because this happens to be a presidential election cycle year. And so what markets do not like is uncertainty. We do not like not knowing what's going to happen. And so companies, businesses, management teams like to operate in a world where we at least know what we're dealing with. Markets can deal with bad news, of course, love good news, but we have to have certainty. Markets just hate the fact that we just don't know exactly where we're headed this November. And I would just make one comment on politics this November is I think there's a good chance we have divided government. And so that's what you want to see if you're going to be in the market, if you're going to be an investor, if you're going to be a business owner, whatever you are, you want divided government. It's much better when not a whole lot of anything happens. And a lot of people think that's a bug of our country, that we don't have things happening all the time, but that's actually a good thing. We want things to move slowly forward over time. And that's what we typically get with divided government. So that's what I would be looking for. If we get divided government, just remember the first year of the presidential cycle. So that means 2025 is historically a very good year. 90% of the time it's positive to the tune of 12% on average returns. And so, yes, this year is a tough year, typically low single-digit returns, but next year on average, not a guarantee of what's to come, but on average tends to be a good year. So that's what you're dealing with. You've got a couple of forces that are going on behind the scenes that are causing some volatility. So that's where we're at now. Let's go through some past corrections. Let's go through some of the things that have happened over the past couple years and talk about some of these other corrections. July through October of 2023, that's last year. I mentioned this already. The S&P was down 10%. Everyone forgot about this. Everyone forgot the fact that stocks are volatile, that they were down last year. December 2021 through October of 2022, the S&P was down 25%. That's when the Fed started aggressively raising interest rates. You remember that? You remember when markets were extremely volatile. We went from basically 0% in interest rates all the way to 5.25% interest rates. That causes volatility. The S&P was down 25%. August through October of 2020, we dipped almost into another pullback coming out of the COVID crash. August to October of 2020, the S&P was down 7%, just a little bit less than what we're down right now. February to March of 2020, we all remember the COVID lockdowns. Remember the massive pullback that happened in 2020. The S&P was down 32%. August to December of 2018, the S&P was down 15%. May 2015 to February 2016, the S&P was down 12%. So just remember, these corrections happen all the time. What the media does is they take a normal correction like this, a normal pullback, and they're going to take 6 or 7 of the most recent stories, of the most talked about news pieces at the time, and they're going to say, these are the 6 reasons why the market's down 10%. In reality, it's just a normal market correction. Market goes down once in a while. People take profits. We take a breather. We don't go up in a straight line forever. That's not how equities work. They take a break sometimes, like they are now. And the media is going to say, okay, here's a normal correction. Here's the 6 reasons why this one is different than all the rest. And if you start buying into that narrative, if you start believing that this time really is different, you could end up panicking, getting off your plan, selling, making the worst mistake of your life, and possibly never returning back to the equity market. So don't buy into the media doom and gloom. Next, don't lose your perspective on where we've been. In 2008, right before the financial crisis, the S&P had peaked at a level of 1,600 points. That was the all-time record high going into the financial crisis, 1,600 points on the S&P. Then by 2015, we had gotten past all the doom and calls for a double-dip recession. The S&P traded at 2,100 points. 2018, we traded the S&P at 2,800 points. Then in 2020, right before COVID struck, we traded the S&P at 3,300 points. In 2022, we hit a brand new all-time record high of 4,760. That was January, right before the Fed started raising rates. We thought we had never seen anything better before, 4,760 on the S&P. And then we hit a brand new all-time record high after all that volatility, after all that doom and gloom, of 5,670 this year, 2024. Don't lose your perspective. And so one of the things we tend to do when we have these corrections is we take our record all-time statement high value, we look at the all-time record that we saw in our online accounts or on our account statement, and we compare everything else to that going forward. And we say, oh, I had $1 million and now I only have $900,000. But if you had looked at a long period of time over 5 years or 10 years, you might have realized that you started with 500,000. You took money out each and every year if you were retired for those 10 years. And now you still have $1 million today. And that's the common story if you talk to many of our clients. And so don't lose your perspective on the long term. Don't forget where you've been. And I think one of the things that happens in markets is sometimes we lose our gratitude for how good equity markets have been the past 5, 10, 15 years coming out of the financial crisis. And so don't be alarmed when we hand a little bit back of our gains. We are still at record levels that we did not have 2 years ago, 3 years ago, 4 years ago. Here's a few key takeaways for you. And if you're going to take notes today, I would write these down. These are so important if you're going to hold on to something during these declines. Six takeaways. Number one, stocks are volatile. Stock market volatility is not risk. Risk is rather defined as running out of money during your lifetime because of the rising cost of goods and services. So for retirees, for all of us, quite frankly, but especially when you get into your retiree years, what's your biggest risk? It's not markets going up or down. It's inflation. And we've certainly seen a lot of inflation the past couple of years. You've seen the grocery store bill go up 40%. You see the cars are 30, 40, 50% more expensive across the board. The homes are more expensive. So what do you do in a high inflation environment? You stay in the stock market. Why? Because companies have the power to beat inflation by raising their prices. And so if you're worried about the price at the pump, what do? You buy ExxonMobil stock. If you're worried about your toothpaste and your deodorant and mouthwash going up, what do? You buy Procter & Gamble. If you're worried about your food going up and your grocery store, you buy grocery store stocks. Because companies have the propensity to beat inflation by raising prices. And that's why you have to be in the equity market. So what's the only price you have to pay to have that inflation beating hedge over time is volatility. Volatility is stocks going up and down. And if you're going to be in the equity market, and I would advise you, don't get into the equity market if you can't handle volatility. Otherwise, you'll lose money because you'll panic and sell, and then you'll buy back in at new all-time highs, and then you'll panic and sell again. You'll buy high and sell low. And that's the opposite of what you should be doing as an investor. So what you need to accept as an equity investor, if you're going to be on a goals-based plan, is that stocks are volatile. Number two, markets don't go up in a straight line forever. They do take a break. They do take a breather. We hand a little bit back. We have corrections. Why? Because there are impatient investors out there. And that's number three. Patient investors buy equities from impatient investors. They buy from people who can't stomach the volatility. And so if you've got steely eyes, if you've got a strong backbone during these times, these are the times where you make most of your money. Just like Peter Lynch said, and Shelby Davis from Davis Advisors said, one of the most famous mutual fund managers of all time, he said, you make most of your money in a bear market even if you don't realize it at the time. Patient investors buy from impatient investors. Number 4, stocks are not a fugazi. You remember the Wolf of Wall Street quote that stocks are a fugazi, a wazi. They're not real. They're fake. They're built on a fantasy. That could not be further from the truth. And I'm here to tell you today that stocks are not a fugazi. They're based on the reality of companies producing profits. And just like Dr. Jeremy Siegel said from the Wharton School, he said that stocks are a claim on real assets. And so what do you own when you own ExxonMobil stock, for example? Well, you own a piece of their balance sheet. You own a piece of their operating assets. You own a piece of their goodwill, of their trademarks, of their intellectual property. And over time, those assets produce cash flows. And when you produce cash flows as a company, your stock goes up over time. And so that's why in 2008, like I mentioned, the S&P was trading at 1,600 points. Today, it's still over 5,100. How could that be possible? How is it possible after all this volatility, after all these different rates going up, rates going down, and no inflation to high inflation? How is it possible that stocks have gone up that much? Well, it's simply companies producing cash flows on their assets. And so when you own stocks, you have a claim on those assets. Number 5, you cannot time the market. And by the way, if you do attempt to time the market, you will pay a massive price because you have to be right twice. You've heard us say this. Not only do you have to know when to get out, but you have to know when to get back in. And that's the problem. Not a lot of people can be right twice. And I would encourage you to try and think about all the people you know in your life that are really successful traders and timers, all your neighbors and friends that you know of that are very rich because of trading the market. I can't name any personally, and I'm in the financial services business. I would guess you probably can't name too many either. But I can name a whole lot of people that have made a ton of money, that have grown their net worth slowly and carefully over time by buying stocks for the long run and holding them. That's how you get wealthy in the stock market. You don't do it by trading and by timing and by getting in and getting out. You do it by holding equities for the long run. Number 6, markets are a discounting mechanism. They're forward-looking. They're an indicator of what's to come. You've heard me say this on the weekly show. You've heard me say it at the events we do, to the point where you are so sick of hearing it, but I'll say it one last time. Markets are a discounting mechanism. They tell you what's coming. So by the time the bad news breaks, by the time that the doom and gloom happens, you already know about it because the stock market's priced it in. The stock market prices in recessions 6 months before they happen. And by the time the recession is actually announced by the media or announced by the financial press, it's too late to react because now the market's already on its way back up, making all-time highs because we're pricing in now a recovery. And so if you can drill that into your brain, if you're going to take one thing away from today's call, it's that markets are a discounting mechanism telling you what's coming in the future. So don't try and time it. Don't try and get in and out. Don't try and outsmart Wall Street. You're not going to be able to do it. You're not going to have more information than the AI trading, and you're not going to have more information than the best hedge funds. And so what you're better off doing is holding on for a long time. And by the way, the hedge funds, the guys who are traders and timers, don't really do that well. If you look at their returns the past 10 years, they've underperformed the S&P by like 3 to 1. And so you're way better off being like Warren Buffett, where you buy and hold for a long time. So this gets into my next point, correction or recession, talking about where we're going. Is the current correction, the 10% decline, a signal of worse things to come, or is it really just a 10% decline and a buying opportunity for patient investors? And so this gets into the market as a forward-looking indicator of what's coming. Now, if we really think there's a recession on the horizon, we're going to get about a 20 to 25% decline. So I don't want to sugarcoat anything and say that we have a crystal ball and know exactly what's going to happen. I'm not telling you that at all. I am telling you the fact of the matter is if we do go into recession, about 6 months before that recession is announced by the National Bureau of Economic Research, NBER, you are going to have a 20% decline. I don't think we're going into that. I do not think we're going to have an all-out, full-blown recession like we would classically think of 08 and 09, Even COVID, we had a small recession, not major. We did have a recession though. What a lot of people don't talk about is 2022, we had a recession. It was a textbook recession. The government never said it was, but we did have 2 declining quarters of real GDP. That means inflation adjusted wealth creation went down for 2 quarters in a row in 2022. We never called that. And so because we had a correction in a recession in 2022, I think it's very rare that we dip back into another recession just a few years later. I do think this is simply a correction, not a recession. And I'm going to give you a couple reasons why I would buy, or I could believe the negative bear case. And then I'm going to give you a couple reasons why I think we should stick with the long-term optimistic view. Here's the bad stuff going on. Unemployment ticked up to 4.3%. It was at 3.5% under President Trump. For most of President Biden's term, it was about 3.5, 3.6. You remember the all-time low unemployment numbers. You remember the record tight labor markets. Nobody could find anybody to work. I think that's quickly changing. If we tick up into 6% unemployment, we will be in a serious recession. I don't think we're going to 6%. There are still 7 million unfilled jobs out there, 7 million jobs in the private sector that cannot get filled. I know they're not all perfect jobs or great jobs or jobs people even want, but they're there. And so there's the ballast built into the labor market. So that's the bad part of it, is we do have 4.3% unemployment, but I do think we've got enough cushion built in where we're going to be okay. Here's another negative: ex-government jobs. So if you take out the government created jobs, private payrolls are softening. Part of the reason for this is because companies are getting a little bit nervous. They're tightening their belt and they're cutting back a little bit. That's part of a preparation in the economic cycle. And so this is not necessarily a bad thing. What would concern us more is if companies were going in gung-ho, not worrying about risk at all, and thinking that everything was going to be fine forever. They're not doing that. In fact, a lot of corporations and management teams today are tightening their belts. They're getting a little bit more careful about how they manage cash. They're doing some layoffs. And so, again, none of this is good long-term for the economy, but in the short term, what it does is it at least provides a ballast to equities. And so you're looking at some of the biggest and best companies out there. The mega caps are sitting on more cash today than they know what to do with. Warren Buffett was just seen taking some profit from Apple. Not a reason to panic. Warren Buffett has owned Apple for a very long time. He does not like to have 50% of his portfolio in one company. He's taking some profit. Here's an easy example. In 1998, Warren Buffett sold his entire McDonald's stake. And so it's not a reason to panic and sell out of Apple stock because Warren Buffett's taking some profit. He's just rebalancing. And we do that for you. If you're our client, if Apple gets up to 10% of the portfolio value, we're going to sell about 2 or 3% of Apple and take some profit. Not because we don't like Apple stock, but simply because mathematically it's too big a weight in the portfolio. That's a wise thing to do. And then I'm going to give you the biggest negative. And this is the last negative before we get into the positives. And that's that the size of government to GDP, government spending as a portion of our wealth creation is too darn high. And right now, government is about 36% of GDP. That's too much. The government has gotten way too big. The federal government is part of every aspect of our day-to-day lives. And it's gone to the point now where it's starting to burden. It's a burden on small business. And so that's why we've told you in the rebalancing process at Investor Day in the past, we're staying away from small caps, we're staying away from mid caps. Why? Because these small and mid caps do not have the compliance armies, all the teams of lawyers and administrators that the large caps do to deal with all the burdensome regulation, to deal with all the tax codes and all the complications that go on with running a smaller mid-sized business. And so that's why what you own matters. And so that is a negative. We do need to see government shrink in size. We've seen it the size of government has increased under Republicans and Democrats. But I will give you one viewpoint that is optimistic on this. We've fixed this problem before. We fixed it under Ronald Reagan. We fixed it under Bill Clinton with the Republican Congress. We fixed it in the past. We just so happen now to be in this kind of big government era. It started with George Bush, and he was a big government Republican, print and spend and make the government as big as possible. President Obama was very similar from a policy standpoint, print and spend, big government. And really under President Trump, we had two bright spots. We had less regulation, we had less taxes, but we still printed a boatload of money. And so when President Biden came in, he added fuel to the fire. He kept printing more money. And that the more and more money you print, the bigger and bigger government gets. Why? Because when you have more dollars circulating in the economy, you have a larger amount of money, of currency. The government, which taxes that currency, gets bigger because it has a wider base of money to tax. And so this is not good. We need to get the size of government under control. So that's all the bad stuff. So I understand that. We're not rose-colored glasses on. We're not trying to sugarcoat any of the doom and gloom articles or stories out there. But I want to weigh that against the good news. The good news is, number one, large and mega cap companies have never been stronger. They have fortress balance sheets. They have so much cash sitting on the sidelines. They don't know what to do with it. And they're going to return that cash to shareholders with M&A, with corporate buybacks, with dividends. So companies are going into this current decline very, very strong. Number two, many consumers still have very strong balance sheets. A lot of baby boomers are debt-free. A lot of baby boomers are sitting on stockpiles of cash, just like the large companies are. And so I know it's not every portion of the economy. I know there's a portion of the economy that's really struggling. That's because of inflation. But when you look at the statistical reality or the mathematical distribution of wealth in this country, most of the wealth in this country is held by very, very strong hands right now. And so we are not going to have the same kind of crisis we've had in the past where people have tons and tons of leverage. So that is a very, very positive thing right now. Number three is fixed rate loans have never been higher. Most people are paying a very, very low interest rate for their mortgage, which happens to be the highest part of our budgets. Typically, if you still have a mortgage, it's probably a large portion of what you spend your money on. And so by fixing your mortgage, like my wife and I did in 2021, you might have done this in 2020, maybe even 2022. What you did was you effectively locked in a very low payment for a very long time. And so debt as a portion of our income, our disposable income right now, has never been lower, even with the student loans where they're at, even with credit card debt rising. I know that's a doom and gloom story out there right now. Mortgage is such a significant factor. It is not weighing down the consumer. Next, earnings growth is still strong. And right now we're seeing some rotation go on through the sectors. It's called sector rotation. When you think about the S&P, if you watch the media too much, you may think that there's only 7 companies driving the market. That couldn't be further from the truth. In fact, we've got all sorts of other types of companies that are producing great profits, that are growing earnings and producing great cash flows. And so for a while, yes, it was technology leading the trade, but this year we're starting to see energy come back. We're starting to see utilities come back in a large way. Up until this most recent correction, financials were leading in a large way. So we've seen some broadening out of where the earnings are coming from. So it's not just one sector. It's not just 7 companies. We're seeing strong earnings growth. And I would tell you, and I know this sounds kind of hard to believe today, but right now, the earnings estimate on the S&P for 2026 is $310 to $315. If you multiply that by the usual 20, maybe 21 times earnings multiple that we give the S&P, you're trading the S&P at 6,300 points. So is it the best buying opportunity of all time like we had during COVID? Is it the best buying opportunity we had of all time like last October with Bye Bye Baby when we put that article out? Not quite, but it's getting to the point now, and I'm willing to say this on this call, that I think this is getting to be a buying opportunity if you're on a long-term goals-based plan. And that's what I want to be very clear on because we are going to get into what I think and where I think we're headed in the markets and why I think you should be a long-term optimist. But I have to preface it by saying you need to be on a goals-based, not risk-based, goals-based long-term plan. So earnings growth is still strong. The Fed will be lower in interest rates in 18 to 24 months. We can see it coming. And despite the Fed, and I think this is a very unique development that we really have not had in the past, the banking system has dramatically changed the past 4 or 5 years under COVID. And what we've had is we've seen a shift of deposits of interest-bearing assets. So think about cash, think about money market, think about treasuries that used to be held on bank balance sheets, shift over to mega cap companies. You see companies like Berkshire Hathaway, Warren Buffett's company, sitting on $277 billion, with a B, billion dollars in cash. That's a lot of cash. You're seeing companies like Apple sit on over $100 billion of cash. And so these companies on their cash are earning more risk-free net interest on that cash than even some of the banks out there. So yes, the large banks are doing very well. Bank of America is doing well. JP Morgan is doing extremely well. But the mega caps are almost these quasi banking institutions now. And we don't have to like this. We don't have to agree with it. But it's a reality of the current economy we're living in. And so you ask yourself, why have mega caps, why have large caps outpaced small caps and mid caps so substantially, especially the past 5 years? It's because we've seen this shift of where deposits are held from banking institutions to large cap companies. And so that's why we like large caps for the long run, as long as you pay the right price. And that's the big key. You have to pay the right price. So, no, I don't think we're going into a massive recession. We could see a small decline in GDP. I think it's going to be similar to 2022, where it's a blip on the radar. This time around, we will have lower interest rates. Dr. Siegel this morning on CNBC called for an emergency Fed interest rate cut. I think he's right. I do agree with the professor. I think we need to be closer to 3.5% to 4%, still somewhat restrictive on interest rates. And I do think we're going to get there. I think there's a lot of pressure politically ramping up here for Powell, and I do think he's going to cut. And I do think we're going to end up with lower rates. And so even if we have a recession, mild, even if we have a little bit more of a correction before we ultimately find the bottom, just remember we're going in incredibly strong. So that's the bull case for equities. Now let's talk about the all-weather portfolio. And I would liken this to the wise man. If you know Matthew 7 in the Bible, the wise man who built his house on the rock. And you remember that there's these two guys. The wise man builds his house on the rock. The foolish man builds his house on the sand, a parable and a lesson for life, but also for investing. And I think when you look at what happens, remember the rains come down for both of them. The rains come down for the wise man on the rock. The rains come down for the foolish man on the sand. But what happens to the wise man? He's fine. The waves come, the storms come, the rain comes down, the hurricane in the market happens, and he's still left standing. What happens to the foolish man on the sand? Well, he hasn't built his house on a firm foundation. And when the rains come and the waves come and all the storms, what happens? He gets wiped out. And so that's the lesson of the markets that we have to remember, that yes, the storms are going to come. Yes, we're going to have these corrections. Yes, we're going to have these pullbacks, but you've got to have your investment house, so to speak, built on a solid rock. So what's the solid rock of investing? How can you build a portfolio that can get through all these different types of hurricanes and weather? And like Jamie Dimon says, the economic hurricane. How do you do that? Well, number one, you run some basic screens on the companies you own. Number one, are they profitable? Most basic common sense question to ask. Are these companies actually making money? And what you'll find is out of 8,300 companies in the US, small, mid, large caps, mega caps, all sorts of companies, out of 8,300 names, only 2,000 today are profitable. And then you say, okay, which ones are not only profitable right now, but we care about next year? Are they going to remain profitable going into 2025? That takes you down from 2,000 to only 1,000. And then you go a little bit further and you say, what kind of companies in those 1,000 have a strong balance sheet that can weather a storm? And you get down to about 100 names. And so my point to you is you just need to be careful of what you own. And if you aren't doing rebalancing, if you're just going into a target date fund, for example, at work and just buying anything and everything, crossing your fingers and hoping it works out, going into European stocks, going into Japanese, going into Chinese stocks, a communist country. This is ridiculous. You're going to tell me you want to go buy stocks in the Soviet Union? Really? At the height of the Cold War? I don't think so. And so the reality is today, there's just not that many companies worth owning. And this is really the Pareto principle, the 80-20 rule, but it's taken to a much bigger extreme. Most companies just aren't worth owning. And so that's why you have to be very careful what your portfolio's in. And then you need to look at What's the right growth to value mix? We tend to like 60% growth. We like 40% value. You need to have a slight overweight, my opinion, to growth so you can continue to beat inflation over time. Then you need to have some value stocks, meaning companies that are more of this plow horse, slower growth, the Procter and Gamble's of the world, the Exxon Mobil's of the world, to provide you a ballast and some dividends in a decline. And then if you have that 60-40 mix just in the equity sleeve growing over the long run, you should have enough to get you through a downturn, but also enough to grow and beat inflation over time. So that's, to me, the all-weather portfolio. Now, the last piece of this is to go back to that goals-based plan that I mentioned before. Don't start with a risk-based plan. Don't start from a lens of out of 1 to 10, 1 being the least risky, 10 being the most risky. I'm going to just go into a 7 because that feels pretty good. I feel moderate. That's not the right place to start from. That's okay. That's part of the planning process. But the most important thing with building a all-weather portfolio and a financial plan is to start from a goals-based perspective. What are we trying to accomplish? Well, number one, we got to make sure you don't run out of money when you're 95 years old. So you don't have to go move in with your kids because they don't want you to move in with them. You don't want to move in with them. So that's the first and foremost goal we have to accomplish, is make sure you don't run out of money. So that's number one. Number two is you might have a house purchase you want to do, maybe some home renovations. You might want to buy a car. You might want to go on a big vacation and take your grandkids. Those are all little goals we can build in over time. And after we build those little goals in over time, and we know that we've got the long-term goal, not running out of money, accomplished, now you can go into the investments and decide what kind of a portfolio you should have. And what I see way too much of today is people starting in reverse. They say, I feel kind of okay about the markets. I'm kind of moderate. I'm kind of conservative, and they don't really have a financial plan that's going to get them to where they want to go. So you got to start from what's the goal, not what's my risk tolerance. So build your house on the rock of high quality on a goals-based plan. No meme stocks, no pot stocks, no airline stocks, Dogecoin, silver coins, Peloton. You got to be in high quality names for the long run. So I'm going to give you some examples. I'm not telling you to go buy these stocks. I'm not telling you to go rush out and purchase these in your own portfolio. I'm just giving you examples. This is general information, not investment advice. But just to point out the fact, NVIDIA is now down 25% from its all-time high. Microsoft is down 15% from its all-time high. Apple's down 10%. Amazon's down 20%. Meta down 12%. Chevron's down 15%. Eli Lilly is down 18%. And so a lot of these companies, I'm not saying every single one is a perfect opportunity or even any of them are a perfect opportunity, but what I am telling you is that these stocks are on sale. And so when Costco runs a sale and they tell you that everything's 10% off, what happens? A bunch of people go to Costco and buy more stuff. Well, if Costco comes out and says, well, forget the 10% sale, we're going to do a 20% sale, what happens then? Then it's like, all right, now a bunch of people are interested in going to Costco and buying the $5 chickens and the $1 hot dogs and all this stuff. Okay, if Costco comes out and says, we're going to do a 30% off sale, it's pandemonium. You won't be able to find a place to park in the parking lot. It's the opposite in the market. When the market goes on sale 10%, people are like, I don't want anything to do with it. I'll wait for the next correction. Then the market goes on sale 20%, a great opportunity to buy, and nobody wants anything to do with it. And then at a 30% decline, like some of these stocks have gone through, remember NVIDIA in its trading history now has gone through 3 or 4 50% declines, all of which were phenomenal buying opportunities. Nobody wants anything to do with NVIDIA. They say, give me gold, cash, treasuries, and a bunker in my backyard. And so the reality is when stocks are on sale, when nobody wants to buy, that's when you make your money. So a couple of final thoughts before we go, and then I'd encourage you to get on the weekly show this week for more information like this. A couple final thoughts. One, this could get worse before it gets better. I don't want you to leave this call today and think Nick thinks this is the bottom. I'm not saying that. I think there's a good chance that we stop pretty close to this, but there is a chance we go further. We could go down 15%. And so just mentally prepare yourself for that. It's not a time to panic. It's a time to buy equities for the long run. Number two, the media is yelling fire right now in a crowded theater. And that's what they always do, is they constantly want to make us panic off of our long-term plan. They want us to leave and sell our equities at the most opportune time to be buying. Number three, using a normal correction happens with the media. They use a normal correction to say this time it's different. I already said this earlier in today's call. It's not different. It's a normal market correction. Number four, you will regret selling. And if you do get back in, it will be at a higher price than you sold. And we've seen this happen to people. You can ask Bon Roth, my business partner, and I, and we both have numerous examples of this where somebody sold out, for example, at 5,300 on the S&P. And when the market goes down to 5,100, they're not interested. They say it's going to keep going lower, and then it maybe does. And then when it does go lower at a great time to buy, they say, oh, no, it's just going to keep going down. And then all of a sudden it goes up a little bit. They say it's a dead cat bounce and it's not real. And they're so glad that they sold out. And then all of a sudden you get a little bit of good news in the market. And remember, markets are a discounting mechanism of what's to come. And then next thing you know, markets are basically on their way back to a new all-time high. And they're going to say, oh, forget about it now. I can't get in at this point. I already missed my time to buy, which is true. And they never get back in. We see that happen to people. Next, you will not remember this correction 12, 18, 24 months from now. You are not going to remember. Just like you barely remember the one from last October when the market was down 10%, I would almost bet you with a high degree of certainty that 12 months from now, 18 months from now, 2 years from now, you are not going to remember this correction. You will remember if you panicked and sold out. You will not remember the short-term decline. And last but not least, stay on your plan, rebalance, use this opportunity to buy stocks while they're on sale. Doing it on a goals-based, diversified basis. Do it on a financial plan. Use this as a buying opportunity for the long run. So subscribe, like the show on YouTube. If you're watching at home today, this will be recorded on YouTube. If you want to share this with friends and family, get this out to them, get the clarity and confidence that they so desperately need so they can stay on their plan. Get on the weekly show. If you need a little bit of extra hand-holding, call us. Give us a call anytime. We're here standing by waiting for you. If you get a little bit nervous, you need to be talked off the ledge just a little bit, call us, Stenger Family Office, 630-912-8295. We're happy to talk anytime. And if you can make it into town for Investor Day, November 7th and 8th, downtown Naperville, don't miss it. It's going to be unbelievable. We got Dr. Ed Yardeni, Andrew Opdyke from First Trust, a stacked deck, got the Family Office panel. Don't miss it. Thanks so much for being with us today, and we will see you later this week for the weekly show.